Perfect. Okay. Let's get started officially. So, good evening, everyone. Thanks a lot for joining today, and thanks a lot for your interest as well in clearing the SIF exam. First of all, when we announced this, just guys, please put yourself on mute, and if you're not speaking, please kind request. Yeah. Yeah, we did not anticipate this much of positive response. That was quite interesting. So thanks a lot. So I'll give you a quick background about who I am, what we do. So my name is Kiran. I think I shared my LinkedIn profile as well with you guys. So just quick background. Spent a couple of years in New York, worked at Wall Street, came back. Now I'm actually based out of Hyderabad. So now we are building wealth management, but primarily the sole focus of SIF at this point of time. We wanted to become NJ Wealth and Prudent of SIF, what they have done in the mutual fund industry. We wanted to do that in SIF, right? So we run this platform called SIFprime.com. Please do check it out if you haven't. I'm sure you might have taken a look. But just to get started on what this program is all about, right? So the first things first. So we will actually run this program with sole purpose of for you to pass the exam. Okay.
అర్థమే కాదు మీ వాయిస్ మళ్ళీ కట్ అవుతాను.
Can you hear me?
Better.
Yeah. Okay. With the sole purpose of clearing the exam, I'm clear, right? Guys, just text, right? Okay, perfect. With the sole purpose of clearing the exam, so that's sort of the ultimate goal. You're not here to, write some PhD thesis, etc. and all. So, what is this program all about? This is sort of a 21-day program. If needed, we will extend that for another day or two if needed. But primarily, just let me give you a quick background about what the exam is all about. So personally, I actually cleared the exam in the first attempt in December. So know how to crack the exam. That's where we sort of built from our experience on clearing the exam. We actually helped a lot of folks as well clear the exam. Now, first point to take out of your mind is people think this exam is super tough. Oh, you know what? There is equity, there is currency, there is a lot of stuff, it's super tough, etc. and all. But in fact, let me tell you, to start with, this exam is one of the decent and easiest exam when you compare with, a research analyst exam or an investment advisor exam. Okay. Why do I say that? Because there are not much of a math that is involved, in this particular exam. There are a couple of case studies, we will go through all the case studies, especially the case studies are little tricky in the currency part. Okay. But from the equity perspective, the most of the numericals are the questions that are being asked are very straightforward. We will try to do a couple of examples today as well. Okay. So the persons first, I want you to sort of remove from your mind, say, thinking that this exam is a tough exam. No, it is not. And 21 days is more than sufficient to clear the exam. Having said that, you need to be little dedicated and then follow us through. Right? Now, how do we study? That's the most important part. So how do we study the exam? Right? Let me actually start with that. Right? What we have done is, if you go to SIF Prime Academy, primarily, see there are we have to study 3 books. Primarily in the sense to clear this exam: equity derivatives, currency derivatives, and interest rate derivatives. Combined together, all the 3 books constitute around 800 pages. Okay, we're not going to read all of that. Okay, and don't worry about reading from page 1 to page 800. No, you need not do that. What actually happens is so there is a couple of themes that cut across this particular 3 books. Okay, what we have done is, if you see here, just let me hit process. People are still joining. Okay. If you see here, primarily what we have done is we have cut the entire 3 books across 8 themes. Okay. If you want to take a note, you can take a note, but you need not actually, right? Across 3 themes, right? So what does it mean by that, right? So there are a total of 10 chapters in each book. So total of 30 chapters. We have divided that 30 chapters into 3 themes. So the first, interesting theme that we will start studying is, futures, which is theme 3, and the theme 4. Okay, the theme 4 is options. Okay, the reason being, both these, if you are able to, if you are able to get this sorted out, the futures theme and as well as the options theme, we have solved like close to 40% of the exam. Okay. Rest of the stuff, and the next one is more of strategies. Strategies are also little easier, right? It's not a difficult task. So the first important part is the futures, where we will study what is the basics of futures. That will cut across. Once we study in equity, it's the same concept will apply to currency and same concept will apply to interest rate. Okay. Similarly with options, we will study CEP. Of course, currency pay, there is appreciation and depreciation. That's a different story. But like mostly the same concepts apply across all the 3 categories there. Okay, we'll study theme 3, theme 4 first, and then we will study theme 5, which are strategies. And then what you can do is you can actually combine theme actually 6, 7, and 8 together. Okay, which is like chapter 6, 7, 8, 9, and 10. Okay, 6, 7, 8, 9, 10 combined together, you can study that, which could be your third theme, and like the fourth theme will be your the derivatives, first chapter and the second chapter. Okay, I'll just repeat that for you. We'll start with chapter 3 across all the 3 books, and then we will study chapter 4 across all the 3 books, and then chapter 6, 7, and 8 can 6, 7, 8, 9, 10 can be studied all at once, or 6, 7 study first, and the 8, 9, 10 can be studied all at once. Because when it is all about regulatory, accounting, taxation, sales practices, investor, it's almost the same thing. You need not study the same chapter in equity first, and then currency later, and then interest rate later. You need not do that. Study once and the same concept applies. And when we go through the 21 days, we will. Guys, please mute yourself. Thank you. Okay, we'll go through the same concepts spread across, cut across these 3. Okay. So in a nutshell, what I'm trying to say here is, we need not study from page 1 to page 800. We'll start with themes and then we'll go, and study further. Okay. Now, how we have structured this, this academy to start with, right? Primarily, if you click on study equity derivatives, here, what will happen is, let me quickly show you one chapter. This is the chapter we'll start today. Introduction to forwards and futures, right? What this is sort of the concept note that you will have here. Of course, once we discuss, I'll actually keep sharing the PDFs as soon as the class is done, so that you can revise that. So primarily, this is all the notes, and it's not like, if you see here, the notes is very concise here, right? Once you understand the concept, this is the only material that is required for you to study for the exam. Nothing else. Don't complicate it. Okay, you need not go through like 10 pages or 8 pages, etc. and all. This is the only material that is required, and most of the questions do come from this material only. Okay, so this is the concept notes that you can of the chapter. And then what you can do is, what we have done is, we have actually put in like lot of we converted into a couple of rules, right? So this is like concept cards, etc. and all. And then we have done, we have given you a couple of questions to answer, practice, etc. and all that. You can go through this. Don't worry about all this stuff. You will be super confident, by class 2 or even at the end of today's classes. Okay.
Kiran, can I have one small query regarding of this actually?
Guys, please let me complete. Please don't ask. Right, I will give you time to ask. Okay, please let me go with the flow. Thanks. Okay. And then there is a final scan, where you go through the core concepts, formula, etc. Right. So primarily what we have done is, we have distilled all the information, made it exam preparation ready, and have given it to you, so that you, once you go through this, you should be able to clear the exam. The as I said, like the whole goal of this entire session is for you to clear the exam. Okay. Now, sir, now go ahead with your question. What was it?
Kiran, thanks for this one. Actually, just my observations here is actually for to complete the fastly the examination is, see, you are done the so much of segmentation. That is very nice actually. Here, what my request is actually, even though suppose one content is there and the mock test questions is going to be asked like that, no, in the suppose there is a question paper is there, and we are having the questions like that. In this each question paper, that the question is related to which chapter and which content like that, that we can able to mark it, no, that will be really going to be helping us and to review for that one. That is the first point. And second point is the terminology. Just I would like to understand whether the exam terminology as well as the in the explanation terminology is similar. If it is that, it is very nice still. Why? Because sometimes because derivatives is and equity part somewhat little bit confusions and little bit similarities are there actually. You know that very well actually.
Okay, okay. In the best interest of the time, the answer to both of your questions is yes. In fact, like if you go through our question book, the way how we have done that, we have actually taken close to 1,500 questions and mapped it across the chapter. We did not.
Nothing.
We have mapped it across the chapter, right? So the answer to your question number one is yes. And whenever we are discussing again, like we will discuss from the exam, from the exam point of view only, right? The concepts or the terminology that we'll be using is primarily geared towards that on. Okay. Of course, what I will try to do is, I will try to make it more practical. That's why if you see there is a broker, that is open on my screen. I will try to make it more practical for you to understand, so that you actually put it in your brain and need not go through again and again. Okay.
Yes.
Okay. Yes. Good. Let's get started. I think in the best interest of the time, I think hope you have clarity on how to read through, right? So picking up on the themes is where we will start with, and then we will actually start with theme 3, and then we will move towards options, the next thing, which is the options. Okay, the first standard theme is the futures. Okay, any questions? Let me take a quick pause. Any questions? If you have
we need to remove this annotation because people are marking on the screen.
Yeah, I think so. Arunji,
Stains need to be removed. That's it.
No, it's not me actually.
No, it's not you. It's
someone else is doing it. Please kindly.
Shekhar or something or name has come.
Okay. Whoever it is, can you please remove the annotation? Thanks.
You are the admin. You can remove from the left side pencil, bottom pencil you have.
Yeah.
You can do that and mute everyone, I believe, because people are not listening.
I think so.
Yeah.
I don't know what to do that, but
you can't help now. 120 people you cannot manage. Mute everyone.
That's true. Okay, perfect. Let's get started. Okay, I'm super excited and pumped. Okay. So what we will do to start with, right? First we will learn a little bit of a concept. Just bear with me for 5-10 minutes, right? Because this is actually the foundation on why SIF as an asset class has emerged and why this exam is all about. Why this exam has even... Okay, guys.
Read a story.
Okay, why this exam has even come about, right? So let me take this quick example, right? All of us as Indians love gold. So for example, you are actually going to a gold shop today, as of today, right? What you will do, so for example, imagine now there is a function tomorrow, or you're presenting to your wife, girlfriend, or you're purchasing for some purpose, and you're purchasing the gold today, which is of an immediate need. Okay, which is of an immediate. Okay, For example, like, today the gold price is 1.6 lakh rupees. Okay. What you will do, is, you will go to, the gold shop, which is, you negotiate a price or whatever. Sometimes you don't even negotiate a price. You purchase the article, and then, like, you pay the price, whatever the price, right? So for example, if it is, you purchase like, 3 grams, right? 3 grams is 4.8 lakhs, right? You actually pay 4.8 lakhs, to the gold shop, and then you take, please, listen to this carefully a little bit. You take the physical delivery of the gold today. Okay, make sense? You take the physical delivery of the gold today. Okay, primarily what you are doing is, you are actually going to a gold shop. You wanted to purchase a certain item. You identify the price of the item. If you have negotiation, you do the negotiation. You lock in a certain price, and then you pay the entire price of the product today, to the shop owner, and you are actually taking the possession of the gold. Got it? Got it, everyone? So this is actually in the real market, in our stock market jargon, right? What happens in the trading is cash. This is called cash market, right? What is cash market? I'm actually going, I'm actually giving the money, and I'm actually purchasing the particular product, and I'm taking it home. Okay. Now, for example, like, if you have to purchase, let me quickly open my broker here. So for example, if I have to purchase Reliance, right? So this is a classic example of Reliance, right? So if I have to purchase one quantity of Reliance, how much I am paying? 175 is the rupees that I am paying. Okay. Imagine now and what is the required margin here? Not intraday, right? So let's do the delivery here. What is the delivery price here? The delivery price is the same price, right? 1278 is the price that I'm paying. And then I'm actually taking, the quantity into my account. In the stock market jargon, what is happening? I'm buying the Reliance and I'm taking the delivery. Similar to exactly what is happening with my gold. Okay, everyone, this is cash market. Now, the whole mutual fund industry is actually based on cash market. What do I mean by that, right? So what mutual funds have been doing is, it's a pooled investment vehicle. We as distributors, we've been giving money to mutual fund, guys. And what they have been doing is, they have been, purchasing, they've been purchasing the stocks in the cash market primarily, right? They're purchasing it, they're holding it, and with the anticipation of that it actually goes. Okay. The entire mutual fund industry is based on cash market. Now, there is a second instance here, right? Now, let's go back to our gold example. What is the second instance? My second instance is, now I don't want to purchase the gold as of today. Okay. But what I will do is, I know the gold shop guy, and for example, like, I have a festival or like, some function in my family that is coming up 1 month down the line. Okay. Now, what I'm going to do is, I'm going to go to the, gold shop, owner, and might be say he's a good friend or whatever it is, right? What I will say is, hey, you know what? Sarji, Agrawalji, whoever it is, I want to purchase, say, 4 grams of gold X. Let me write this. I want to purchase 4 grams of gold at X price, 1 month down the lane. Got it? Just listen to this carefully. I am purchasing 4 grams of gold, but what I'm doing here is I'm actually locking in the price. The price is being locked by me. And also the price is being agreed by the gold shop guy. Okay. Because, for example, I might anticipate that the price can go up, or whatever the gold price is. But like, I'm actually going and locking in the price with the gold shop owner. But here what is happening is 2 things important. In this first instance, what happened here? I paid the cash and I took the delivery. Both has happened here. Okay, in the cash market, right? In this market, what will happen is, I will not pay the money today. And point number 2, I will not take the delivery today. Got it? When is this going to happen? This is going to happen 1 month down the lane for me. Make sense, guys? Okay, I'm just repeating this here a little bit here. I'm going to the gold shop owner. I am, freezing on the quantity and the price, but I'm not paying the money today, and I'm also not taking the delivery of the gold today. Okay, but what I'm saying, I will come after 1 month, and then I will actually pay you the money, and also at the same time, I will, and I will, take the delivery of the gold. Okay, makes sense. Now, what is happening here? What is happening here? I am, people have asked about the jargon, right? So I will talk in only jargons, right? What is happening here? I am actually, entering into a contract, right? See, like what I'm saying to the gold shop owner is, I like, okay, you know what, Sergey, right? We both agree, and then I'm entering into a contract with that particular gold shop guy. Okay. Now the whole SIF, right, is actually built on this primary. Of course, there is long, etc. and all that. SIF as a strategy, the derivatives, the long, short, etc. Everything is based actually on contracts. Okay. So contracts has been there from so long, but has been never used by the mutual funds, unhedged, etc. and all that. But now they have to use more and more contracts, So that is where the SIF as an asset class is coming into the picture. Let's not get in there, but let's focus here. Okay. Now, what is this contract called? This contract is actually called forward contract. Okay, because why? I'm actually paying after 1 month, and I'm actually taking delivery after 1 month. Got it? Clear? Until here, everyone? Okay. So if you have any questions, please put it in the chat, but what I will do is, I will take quick pauses, once in 15 minutes, so that we can, go through any questions asked. Now, what is the main problem with the forward contract? Okay, let's quickly understand that, because this is exactly the basis of why why our whole capital market ecosystem has even evolved, right? Now this is unofficial, right? This happens in an every day, with whatever the gold shop owners that we are actually dealing with, in an unofficial capacity. So what are some of the challenges here? It might be after 1 month, what I can do is, I will say, might be I'm not interested in taking the delivery of the code. I might say, what, I think the price has reduced a lot. For example, today the price of the gold is 70,000. Tomorrow, the price of the gold has fallen to 63,000, right? 1 month down the line. There is a possibility that I can say, even though I have locked in a contract, right? In informal capacity, I can go back and then say, what, I'm not going to honor my contract because the price of the gold has fallen from 70 to 63K. Okay. There is that another, problem that is there in the forward contract. And then even if I wanted to honor the contract, might be I will say, instead of 70,000, I will pay only 67,000 now. Might be I will pay 3,000 later, or might be I will say I will pay 50,000 now. I'll pay 20,000 later. These are all the problems, which also happens in the gray market, in an unofficial market, even as of today. Okay, in the forward contract markets. Okay, to overcome this is where the futures as a contract came into picture. Now understood, the evolution here. The futures as a contract, has come into the picture. Whatever is happening, from 9:15 to 3:30 in the Indian markets, especially on the contracts, is nothing but future contracts. Okay, I'll quickly, explain the difference between what is the difference between forward and futures. Now, what happens in future contract is there is exchange. What is the exchange for us? There is NSE and BSE, which actually defines the contract. What is the price, what is the quantity, etc., and all that stuff, except the price. Except the price, the exchange defines everything for me. Okay, point number 1. And then what did I say just few minutes before? There is always a possibility of either me defaulting it, or like, say for example, if I pay all the money and say the price of the gold has increased from 70,000 to 75,000, the gold shop guy might say, you know what, I might not deliver the gold for you because you have to pay me additional 2,000 or 3,000 or 4,000. Okay, there is that possibility as well. What is that called? That is actually called settlement, right? Right? That is called settlement. What is settlement? Like, I pay you the cash, you pay me you give me the gold, right? Or vice versa, right? You give me the gold, I pay you the cash, so that is called a settlement. There is always settlement risk in forward contract. Now, what happens, in the markets, settlements are done by CDSL and NSP. Got it? Why these guys even exist for us? Okay. The contracts are defined by exchanges. And then the settlements are actually done by CDSL and NSP. Okay. Now let me quickly go to my PPT, just to start with. Any questions under here, guys? If please put yourself on mute. Thanks.
Sir, difference between forward contract and future contract.
Guys, you understood the differences, right? Now? Okay. Perfect. Primarily, I think
Kiran, in the futures, it may be the discounts and the premiums also going to be introduced here, because it is giving the clear difference between the contract and the forward settlements, so that we can have the clear difference between the forwards and futures actually.
Sorry.
Discount prices as well as the
He will discuss everything.
No. Guys, hold on. Okay. Cut. Okay. Let's not. This is not a university class. Okay. First of all, right? See, there will not be any discounts primarily. Point number one, right? Forward contracts, or especially the future contracts, are standardized contracts. Okay. There is no discount mechanism, that happens in the market. Point number one. Okay. What happens with the exchanges is, exchanges will define you the quantity. Exchanges will define you the they won't define you the price, but they will define you what is the
lot size.
Exactly. Sorry, yeah, lot size. And what is the settlement mechanism, etc. and all. Okay, there is no discounting that happens in the futures for now. Okay, don't get into the discounting part. Okay, cool. Okay. The first thing what I wanted to do is, since we said, we will actually study this, with the aim of clearing the exam. You generally will have, one of the very standard question that you will have is, why, the futures, have come into the picture. You should be able to answer that. There is problem with standardization, transparency, liquidity, and clearing support. All of them, are being cleared by the, futures, right? So that's what, that we discussed just now. Okay. Now, okay. Just quickly. Okay, perfect. So now, what exactly happens on the? We'll quickly start building on the futures part. Okay, don't confuse on the options. We're not studying options today. Options we will study tomorrow or day after. We're only studying the futures. Okay, the contract is related to the futures only. Going back to our Goldsmith example. Okay, so now there are what are called as what did I say here? Let's go back to our Goldsmith example very quick. Because this is a very interesting important question that NSM is so favorite about, especially for the SIF exam, right? So here, I was talking about the delivery of the contract 1 month down the line, right? So that means like what? I can go to the Goldsmith and I can ask for only the delivery after 1 month, okay, in an informal capacity, okay. But this is a very important question. So in the Indian market, the forward contracts are available for you for 3 months. Okay, please make a note, for 3 months. Let me quickly show you here. me go back here, that's why I wanted to tell, like, we will do a little bit on more on practical mode. Second. Okay. Here, there are a couple of things, we will actually start focusing on index, contracts, and then we will go to the stock contracts. First of all, in index contracts, let's see Nifty, right? Nifty 50. If I go to, the contracts here, always remember the very important thing, the contracts, for indexes are available for 3 months. Okay. The present month, the next month and the month later. Okay. If you see here, I have put in Nifty futures, right? If you see, there are July futures that are available, August futures that are available, and then September futures that are available. Okay. This is a very, very favorite question, and without this, there will not be any ease. Okay. So when it asks, right, how many contracts are generally available, like, especially in the index, or not even in the index, and it happens even in the stocks, especially in the equity derivatives, 3-month contracts are available to us. Okay. So similarly, let me quickly show you Reliance, which is a stock, F&O. Same thing happens here, right? You have July futures available, you have August futures available, and you have, like, the September futures available. Okay, guys. So that's like, what is the time frame the futures are available in the Indian context? It's actually the 3 months there. Okay. Now, I will take this quick example here itself, and I will actually show you. Maybe let me add Reliance futures quickly. I hope most of you do. If you do, options and futures, this exam is very, interesting, very easy. But, like, don't worry about that, right? Okay. Primarily. Now here, this is the most interesting part. We'll just sit on the screen, and then, like, we will learn a couple of concepts. Here it's okay. So normal is you need not check that. Okay. Primarily, right, so primarily, right, primarily, the one interesting another concept, that the exam generally asks is, what is the contract size? Okay, what is the contract size, right? What is generally the contract size? So futures, has always a contract size which is defined by the exchange. In this case of Reliance, it is actually 500 as a quantity. Okay. Now, what the quantity is one part, and what is the present value of the contract? The present value of the contract is 1275. Okay. One interesting favorite question, for this exam is they generally ask you what is the contract value. Okay. What is the contract value? Always it is lot size times what is the price of the contract here, right? Now, quickly, let's look into this, right? Here, what is happening? Because I'm going to introduce a couple of concepts here, again, completely related to the, exam perspective itself. So 500 times, let me quickly open my calculator. So 500 times 1275, close to 1275, right? Okay. Now, what is the actual contract size here? Please note this carefully here. We will introduce a couple of concepts. What is the contract size here? The contract size actually is 6,37,500. Got it, everyone? But please, look here in the, below here, right? What is it saying? For me to buy this particular contract, I don't need 6,37,500, but I just need only the margin here. Okay. If I pay 1,15,795, I will be able to purchase this particular contract. Got it? Guys. Okay. you're able to get this, right? Okay. Now, let me go back here a little bit. So, future contracts, are like, are the futuristic stuff, right? So for example, let me go back here, right? One thing. So the goal thing, what exactly has happened, in the futures contract, we have told that, I am going to take the quantity and I am also going to take the delivery of that particular commodity in the case of the gold after 1 month. Okay. So just, do the mapping of that to what exactly just now I showed here. What is going to happen in this particular contract in the part of the Reliance? I am going to purchase a contract of Reliance with a lot size of 500. Okay, where the current price is 1275, and if I'm buying it, I'm anticipating the Reliance is trying to go up, okay, which is called long. Okay, we'll introduce that in a second. But now, having said that, the actual price of the contract is 6,37,500. The first question is, am I going to pay the entire amount of the value of the contract? Absolutely not. Why? Similar to the gold concept. The gold concept also, what happened, I have locked in a price, but I'm not going to pay the contract value at least until the end of the month. Okay. But here, what happens is, in case, if I default, in case if I'm not paying anything, okay, in case if I'm defaulting, if I'm taking this contract and if I'm defaulting it, in the case of the gold, what is going to happen? What happens is exchanges will ask the brokers, please understand this, this is a very important question as well. Exchanges will actually ask the brokers to charge a margin on the contracts. Okay, please note this. Exchanges will ask the brokers to charge the margin for the clients. Okay, now I am the client, I am the buying the Reliance futures contract, and what exchange is doing? Exchange is asking me to buy this particular margin, 1,15,000, 795, for me to enter into this particular contract. You understand? Okay, we will convert this into questions, but I want you to understand this concept. Generally, this margin is anywhere between 10 to 15%. That's irrelevant for the exam. Whereas for the stock, for the stock futures, the margins are generally little higher, somewhere around 18 to 40%. It again depends on the volatility of the particular stock and, multiple factors there. We will not get into that. Okay. Clear until here? Okay. So this is one part. Then I will quickly introduce you what is, might be since on the screen itself, right? Let's quickly understand this part here, and then we will build that into questions also, in a bit here. Okay. Now, you see a couple of things, that are out there on the screen itself. There is something called as a bid. There is something called as an offer. Okay. What is a bid? Bid is something, always, remember this, B for B. Okay. Bid is what a buyer is looking to buy. Okay. That is the price at which the buyer is willing to buy. Okay. Offer is the price at which the seller is, willing to sell. Got it? B for B, bid is the price at which the buyer is willing to buy, and offer is the price at which the seller is willing to sell. Okay. And I want you to keenly observe, a couple of things here on the screen. There is 1275.10, there is 1275.00, 1274.90, etc. and all that. Okay. What are these called? These are actually called ticks. Okay. These are called price movements, but the price movements are reflected in ticks. Okay. This again, any very interesting, very important, interesting question. In Indian market, the exchanges and the SEBI allows you that the tick size to be 5 paisa. Okay, what do I mean by that? So, for example, if someone of you has put in the price at 1274.90, I can actually put my next price to be at 1274.95 or 1274.85 in the magnitude of 5 paisa, ticks. Got it? This is a very, very important question again. Tick is the minimum move allowed in the price quotations, and in the Indian market, it is actually 5 paisa. If you see here, there is a little bit of a 10 paisa that is out there, because it's a stock. But let's quickly see, might be the Nifty real quick. Right. See the market depth. Okay, we don't have it. Okay, this more of this thing. But like primarily the tick, that is available in the Indian market is, the 5 paisa per. Okay, what is the minimum price movement, that is happening here. Okay. Now, while we are on the screen itself, we'll quickly, do a couple more stuff. Now, what am I buying this? I am buying a futures contract for the month of July. Okay. Now, what happens is, the contract has to expire, right? That's again a very interesting popular question for, NISM. So, when do these contracts expire? Especially the contracts expire twice in a week for us, right? The contracts expire, especially for options, if you take, there are weekly expiries. But for futures, we have only monthly expiries. Okay. For the contracts on the NSE exchange, expire on every Tuesday. And please, for the future contracts, they expire on the last Tuesday of every month. Okay, please note this. They expire on last Tuesday of every month. Okay, in case if the last Tuesday of that month is a holiday, it will expire, the day before. That means, it will expire on Monday. Got it? This is a very, very important question, and without this, again, there is no exam. Okay. So every contract, will expire on, especially the future options contract. When we study, we will study that. But like every future contract, has a monthly expiry, and they expire on last Tuesday of every month for NSE and last Thursday of every month for BS. Got it? Okay. So these are like, couple of, things that just I wanted
Kiran,
to share.
it's Thursday, I believe.
Let me take a quick pause, meanwhile, before I move to the PPT, and we
Kiran,
quickly go through a couple of questions related to this. Any
Kiran?
questions so far? Can feel
Hello?
free to unmute and talk.
Can you please explain the tick again?
Sir, 1 second.
Kiran, just I have forwarded the queries in the chat box also.
Okay, 1 second.
Kiran, it's last Thursday, I believe.
Which one?
The contract expires on last Thursday.
Okay, I will double check on that, but NSE is Tuesday. Okay, I will double check on that.
Sure.
Okay, please explain tick again. I'll come. Margin is fixed.
BSC is Thursday, I think.
No, margins, BS, sir, Tuesday is, NSE is Tuesday, BSC is Thursday, but I will double check. Yes, but I think we correct there, but like I will double check, but because I do day in, day out trading on it. Okay, margins are not fixed by exchanges. Guys, please note that this is a very important question. Whoever has asked that, this is a very tricky question as well, right? Exchanges ask the brokers to fix the margins. Okay. The margins vary from broker to broker. Sometimes the margins are generally fixed by brokers, not by exchanges. But it is mandatory for the brokers to charge margins. And also, this is a very important question here. Let me quickly go back here, so that I quickly cover this part here, right? So if you see here on the Reliance, right, you see there are two buttons here. What is this? There is a buy button and there is a sell button, right? B and S. What is B? Might be we'll introduce the concepts here as well, quickly. What is B? B is buy. What does it mean? If I believe that Reliance will go to say 1300 or 1310 or 1320, okay? Today is July 8th. Might be by end of this month, if I believe that the Reliance price is going to go up to 1300 or 1310 or 1315, I will actually do a buy. Okay, which is what, I am actually taking a long position. I'm introducing this. I am taking a long position, which is called what, right? I am anticipating the stock price will go up. Okay, the futures price will go up. Okay, where I will make money. In case if I feel the price, this which is 1275 today, falls to 1250, 1230, or 1220. Okay, so for example, if I'm finding weakness in Reliance, okay, what I will do is I will actually sell. You see here, I will be able to sell. No, sorry, not me. I will actually sell this particular contract. Okay. Now you observe, right? Even for the both and the sell, the margin is almost the same. Okay, the margin is almost the same. Okay. Okay. This is the point I want to tell you to, right? This is a very interesting, popular question, and we'll go through questions just in a bit. Margins, please note, margins are paid both by buyers and sellers. Here I am a seller of the contract, I'm still paying margin. I am a buyer of the contract, I am also paying the margin. Margins has to be paid both by buyers and sellers. Okay, which is a very interesting, important concept. Again, a very popular question and a very, sort of a favorite question for NIS. Okay. Okay. Now let's quickly go through, might be some stuff. Yeah, Nifty is NSE correct. Yeah, Sensex expires on Thursday. Tick again, I will come to that in a bit. Bid is buyer, ask a seller. Kindly repeat the last one. Okay. Yeah, margins will be changed from time to time. Again, that is purely, okay. What happens is, July 8th, my margin is, 1,15,000, what I have seen on the Reliance. As I go along, as I progress through the month, what happens is, the margins will keep going up. Okay. Because what, the contract is going to expire, so the margins will keep going up based on the time horizon speculation. But don't worry about that. When we go into this stuff, right, we'll complicate ourselves. The goal here is to sort of study whatever is required, for the exam. That's it. Yeah, near month, far month, farther month, correct. Future contracts. Yeah. Okay, I think you guys got it. I mean, I don't know what questions, let's quickly go through the questions, right? I think we covered, some concepts here. Almost touching 8:15. Okay, let me zoom this here.
And
Okay.
Kiran, the margin will be changed in a day one time, or it is going to be changed many times also?
See, margin is fixed by the broker, it doesn't change on a daily basis, But again, don't get into that, That's more like, we will become fund managers also. So why do you want to do that for now? First, let's clear the exam, then we'll become a fund manager, Yeah, cool. So I'll quickly, sort of, what I mean to say, revise the concepts here, right? Whatever we have discussed. See, there forwards are flexible and but there is risk associated. That however we mentioned. Why futures have come into the picture? Because of the standardization, transparency, liquidity, and clearing support. Okay, who does the clearing support? The settlement mechanism is done by clearing corporation. Okay, the clearing corporation in India are NSDL and CDSL, which is very important. Okay. Now, what did we say? The futures move the forward price, forward promise onto an organized exchange, which is in this case our, NSE and BSE. And these are all completely exchange traded, standard contract terms. We've studied all this stuff. I've just now shown you, right, when I'm buying the future, I'm taking a longer position. When I'm selling the future, I'm actually taking the short position. Okay. Now, the most important part, I have highlighted, one sentence there. The futures trade is just figurative, right? See, what did we see? The actual contract price is 6,30,000, which I'm not paying. I'm only paying margin, which means I'm ideally not paying any money to the contract here, okay, because there is no money exchange that is involved, similar to the Goldsmith example, previously, okay. Okay. Now, contract value, which we have seen already, 500 contract value, Reliance, and then 1275 is the price. My contract value is 500 times the 1275, which is whatever 6,32,000. That is, this is a very important, concept. We will do 2 to 3 numericals, before we wrap up the session as well on this, concept here. Okay. Next. Okay. We studied this 3-month cycle, this month, next month, and the month later. Okay, we have 3-month cycle, especially on the contracts. Okay, expiry logic we discussed again. NSE is Tuesday, BSE is Thursday, BSE is Sensex, NSE is Nifty. Okay, yeah. This, nothing much here. Okay. Okay, someone asked about tick, right? What is tick? Tick is, for example, what is the, like, if the price is trading, right, so for example, if someone has put in an order at 100 rupees, I can actually put an order at 100.05, right, which is 5 paisa. Okay. Okay, always remember, please remember this, very, very, very important. 0.05 is the tick, okay, in the Indian market, because we will actually use it for, calculation purposes. There are a couple of numericals which we have to use. The tick in the Indian market is 5 paisa, which is 0.05. Okay, so I can put the price at, the bid price at 100.05, and someone can actually put it at 100.10, which is, and then, like, someone can put it at 100.15, 100.20, 100.25, like that. Okay, so it's in the increments of 5 paisa is where I can actually put in the price here. Okay, bid is what, like, which is B for B. Just remember this blindly, right? Buyer is willing to pay, ask the seller is willing to sell. Daily settlement, final settlement, we'll cover it tomorrow. Don't worry about that, right? Wanted to cover basis, but I think we are running out of the time. But let me quickly do 2 to 3 numericals here quickly, which we have also done for you to get confidence, because these are very famous numericals that NISM loves. Okay. Okay. Okay, this is very famous numericals, guys. I want you to sort of attempt this if possible at your end, and we will do this just in a second. Okay, the question is, a trader buys an ABC stock futures contract at rupees 768, and the lot size is 1200. Okay, what is his profit or loss if he squares up the position at 778? It's very easy. What is the answer? Real quick, you can put it in the chat. Very good. Yeah, 12,000. As simple as that. So that's what I told you, right? This exam is very easy. Just that you need to get it done. That's it, right? Simple. 768 sells it up at 778. He makes a profit of 10. What did we say? You have to multiply with the lot size. 1200 into 10 is like quickly 12,000. Okay. Let's see another question here. Yeah. Again, calendar spread possible to set. How many? There are 3 calendar spreads. What did we say? This month, next month, and the month later. Okay, quickly. Okay. Now I wanted to do this here, right? Now, what it is saying is, Mr. Ganesh thinks that the markets will go down. Okay. So what he's doing, he's selling 10 lots of index futures at 3,500. Okay. His predictions has come true, and the index falls, and the price has come down to 3,410. Okay. What is the profit Mr. Ganesh has made if one lot index is 50? Okay. It's very easy. Very, very easy. Give an attempt. Yeah, I mean, you guys are smart, yeah. Come on, why do you need this? 45, that's it. As simple as that, right? Why? 3,500, if and let's do the reverse thing, right? Now let's see if the price has gone to 3630, right? What is the profit or loss? Let's do that exercise as well. the price has gone to 36.30 instead of 34.10. No, tell me the loss amount. Okay.
Profit.
No, 36.30. Okay, let's do the quick calculation. For those of you who don't know this, it's very easy. Guys, just hold on. Let's take a quick breather. I know you guys are super good. Okay. For those of you who don't know, right, let's solve this, right? What did we say? What did we say? You have to figure out the lot size, right? First of all, what is the lot size? The lot size is 50, and he purchased 10 lots. Okay. Let's do the quick math here. First of all, 10 times 50, right? So total quantity there is 500. Okay? Times, what did we say? What is the price? The price is 3,500. What he has purchased is at 3,500. Okay. So this is, 1 lakh, whatever, 17 lakh 50,000, right? Then, he has, sorry, this is the purchase price, right? So he has purchased it with the aim of going it down. So it has gone down. Selling means what? Like, when the price goes down is when you will actually make the profit. Okay. So 3,500 minus 3,410 is what? 90 rupees, right? So either you can do that or you can actually simply do this, right? Let me quickly do this. 500 times, what you can do is, guys, please don't use the annotation. I will try to fix it. 3,500 minus 34, 10 is, 90 times 500, right? And which is the quantity. So he will be in a 45,000 profit. Got it? So what did I ask before? If the price is going to 36.30, right? What is going to happen there? 36.30, that means the price has gone up, that he has to make a loss. He has sold it, but instead of the price going down, the price has gone up, right? So that means 3,500 minus 36.30, which is what? Minus 130 times, what is our quantity? 500 minus 65,000. Someone is, most of you have got it correct on. Yeah, 65,000. That's correct. Not 45K. 45K is someone. Yeah, perfect. You got it, right? So these are the sort of the questions, right? And by the way, like, you might not be surprised if you get like some sort of ditto question there as well. Yeah. Perfect. Okay. I think we can wrap up the session today here. We will go deep tomorrow because I think for the first 15 minutes, we were talking a lot about the structure, etc. and all. What I wanted to do is, if you want to go through the chapter, but I don't recommend it. Yeah, that's correct. What I will do is, I will share the PPT and as well as this recording. If you want, just go through that. That should be more than sufficient, for you. Sir, everything is there on the website, sifprime.com/academy. Bhavin, put it here. But just to close, any questions, feel free to unmute and ask.
I asked the futures profit, how the taxation.
Futures profit, how the taxation, we will study in taxation.
Okay.
There is an exclusive chapter called taxation. Don't worry, we'll study there then.
Okay.
Let's not complicate. Let's learn the concepts here. Yeah.
Kindly put the website address in the chat.
I put it here,
Hello.
sifprime.com/academy.
Future contract on which date it is expires?
Very good. Sir, futures contract always expire on the last, Tuesday, of the month. I think I mentioned that. Again, I'm repeating that. Futures expire on the last Tuesday of every month. Okay. In the case of BSE,
forward contract, sir?
We don't have forward contracts. Forward contracts are not standardized, sir. Forward contracts are the jugaad that we do with the goldsmith and our vegetable vendors. What do we do, right? Forward contracts doesn't exist. Forward contracts are not standardized.
Okay. They are OTC.
Sorry, they are OTC, correct?
Okay.
Kiran Farhad here. So my question is that in the gold example that you gave in the forwards contract, so in that case, the quantity into the lot size would be what the amount would be paid at a future date, correct?
That is correct.
But
Yes.
in futures contract, if I have to buy the same thing, I will only have to pay the margin and not the entire amount, correct?
Perfect, correct. That's why if you do the trading, right, generally if you are in the last week of the month, right, the brokers will not let you to buy the contracts. They will say, don't buy this month contract rather than buy the next month contract, because in the last week of the contract expiry, you have to almost pay the full price because it is getting to the expiry date and you are getting to the delivery. Okay, so yeah, in this case, at least until the last week, what you do is you actually pay only the margin.
Margin. Thank you.
Yeah, I think one of the sir actually mentioned very important jargon here. Please note, I think this is also very important question. The forward contracts are all OTC. Okay, OTC is over the counter. Okay, that means this is the counter for me, right? You and I are dealing. There is no third party there. Okay, so forward contracts are all OTC contracts, by the way. Future contracts, are not OTC, they are standardized contracts. Very important, I think, because this is a very important question that actually comes as. Okay.
Whether forwards are going to be maintained by the exchanges or it is not going to be done through exchange?
Forwards are not even present.
Okay. Yeah. Is there any question?
Can you repeat? Can you repeat?
Also?
Sir, 1 second, one at a time. Sorry.
Can you repeat? Future forward contracts are all OTC, you said. Futures
are standardized.
Future contracts are all standardized contracts.
Yes, that's correct.
Sir, who would be actually trading in forward contracts then? See, we retailers are all trading in futures. So there is
no forwards on the exchange, ma'am. Don't worry about it. I took it as an example.
It is for my knowledge.
No. Forwards are mostly. I don't know if you joined with late. Forwards are mostly what we do in an informal economy, right? For example, I'm going to the goldsmith shop and I'm saying, hey brother, right? I wanted to purchase, 4 grams of gold and I'm locking in today's price, but I will pay you after 1 month. I will take the quantity delivery after 1 month. So those are all forward contracts. Also forward contracts do happen in commodities very, regularly, right? For example, right, so say imagine now I'm cultivating, paddy or rice, right, or anything. Generally, what ITC does, most of the times is ITC goes to the farmers and then it will say, how much of the produce can you do, this quarter or this month, right? Or might be for this crop season. The farmer will say X quintals. ITC will say, I'm going to buy this X quintals and at this price. They will lock in the price. Okay. But they will not buy the quantity because the quantity is not there. Point number 1. And point number 2 is, the price or discovery will happen. There is no quantity and ITC will not pay anything as well, to the farmer. What they will say is it's just a promise that I will be buying your product might be after 1 month, 2 months, 3 months when the crop is available to me. Okay. That is a forward contract, mostly which happens in agri and commodity space. Not generally, whatever contracts happen on the exchanges are all standardized contracts. Otherwise, with due respect, NSE, BSE, CDS, and NSD won't exist. And
yeah, one more important update.
Sir, 1 second. Ma'am, did you... Sir, 1 second. Sorry. Ma'am, did you understand that?
I got your point, sir. I understood the concept now. Yeah.
Perfect. Thank you so much. Sir, go ahead. Yeah.
Yeah, in the commodities, that futures contract expiry will be changed from script to script actually. Means suppose silver will be going to be different expiry date and the gold is going to be different expiry date, and it is going to be even extended to the 6 months or 12 months also. Commodities. This is very important update actually that we need to make it up in a note on that.
Yeah. We will actually do when we do currency derivatives, and like we will learn more. Because whatever we have learned is very little simple. There is like law. I mean, unfortunately, what this exam does is one thing is there's little bit of a trickiness on the currency and the interest rate. They will complicate that a little bit. Okay. But we will do that. Okay. Cool.
As well as this, there is any questions regarding of swaps also?
Sir, we will do all that. Primarily swaps. Everything will come in the options part, right? So we are trying to keep it simple. That's why I started with derivatives.
Okay. Sure. Please go ahead.
Please explain what is it. Okay, cool. Okay. Chalo guys, thank you so much. Then what I will do is I'll try to upload the recording. Say I will create a Notion document. It is like a simple page there, right? I will upload the recording there. We can access the recording. I'll put it in the PPT as well there. Someone has asked me what should I look for in the SIF Prime Academy today, right? Yeah. What you need to look for SIF Prime Academy is go to equity derivatives and look for chapter 3. Okay. Go to equity derivatives and then look for chapter 3. Then you should be able to revise that. Good. Chalo guys, thank you so much, and we'll see you tomorrow. Okay. Bye. Take care. Have a good night.